Yeah, we look at all that, breaking it down to consumer and then commercial and industrial and commercial real estate. Consumer is still a strong balance sheet, but their personal savings rate are now below the 30-year average, 6.3%. It got as high as 18%. So we're going to see loan balances creep up, particularly for credit cards. That will be generally a positive, but in terms of where there is stress for the consumer, it has to do with inflation, rising cost of living, food, fuel, housing costs. All these are reducing discretionary spending, which might be for leisure or for services. So I think for the consumer, nothing alarming in terms of loan provisions, but there's cracks in the wall. The commercial, industrial, and real estate, it is amazing that there is not a distressed industry that we need to talk about. And that is unusual going back over many years. But over time, if we do have recession, we could see some troubled companies or some troubled industries. Russia really is not material. When Jamie Dimon says 1 billion over time, that's a small number, and it might be in trading derivatives. It could be in some correspondent lending. But none of the U.S. banks really have that much exposure. Citigroup probably has 15 to 20 billion, but not all that's going to be written off.
All right, it's good to know, Ken, ahead of earnings this season. Look, so on JPM, you've got a 12-month target of 175 versus, let's say, 136 where we are now. That is still 28% upside. How is it going to get there, especially when you've got Diamond talking about paring back on share buybacks?
Yeah, and so is the consensus with a high target. They're going to come down. It's just that we're going to recalibrate what we think will be the outlook for the rest of this year. The bull case scenario here is that if the Fed can manage a stable or growing economy, we have rising rates, and the banks have enormous amount of dry powder with very low total loans to total deposits. It's the lowest we've seen in 20 years. Banks are well capitalized. So the bull case for me would be that we're going to see increased net interest income and increased loans. We also have significant return of capital once the Fed comes out with its published stress tests the end of June, which means more dividends, more buybacks. These stocks are trading at low valuations, both historically to the bank averages and well below 50, 60% to the S&P 500. So in there is a bull case, but right now the market is not buying it.